Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. With July's U.S. CPI reading now booked and showing inflation growth, we sit at the countdown to next week's highly anticipated Federal Reserve rate decision. Expectations are still for a cut, but the data could serve to muddy the rationale for it in some quarters. Home builders are a subsector that often see valuations bottom in the midst of a recession. At the moment, though, this may not be the case. What is the current setup for this traditionally interest rate sensitive subsector, and why might its near-term future picture for the home builders mark the interest rate story less influential to his multiples expansion story? Our next guest reminds us that starting points matter. Please welcome back to Fidelity Connects, Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Hi, Denise. How are you?
Hi, Pamela. I'm well. I'm enjoying the fall weather in Boston.
Oh, I bet it's glorious. It is a lovely time of year. Great to have you with us here. It's lovely here in Toronto as well. Let's have you just give us a couple of thoughts on the inflation report. We saw CPI this morning. It was higher. It was expected to be higher. Nobody's really flinching. Is that right?
Yeah, I think that's right in the sense that nobody flinched. Certainly the market didn't. I think overall CPI came in a little bit higher. Core CPI came in line. The interesting part is always remember that the Fed focuses on the PCE deflator, which does run a little cooler statistically than the CPI overall. And the PCE deflator is made up of elements that are in the core CPI and elements that are in the PPI that we got the day before. And you put those two together, and most analysts are actually estimating a 0.2% rise in the PCE deflator. So yet we sit again wondering if we will see a broad-based rise in inflation from the impact of tariffs, and it keeps getting delayed. Or certainly not. We're not really seeing it be in a broad-based fashion, which again gets back to the point that the Fed has the potential to renormalize policy because inflation hasn't arced up the way that I think they initially thought that it would going forward. So I do think this probably cements the cuts cements the odds for a cut with the next meeting. And I think that creates an interesting dynamic for the market because we still are in this kind of slow growth, but not a recession format of the U.S. economy, which when the Fed is cutting because they can, tends to be bullish for equities.
It's so interesting. So as you say, the cut could transmit through to equities and make that picture a bit shinier overall. You're looking in some recent research specifically at the subsector for home builders. They traditionally are very cyclical, very interest rate sensitive. It's an area, of course, you think of housing, anything to do with it being very interest rate sensitive. But you're looking at something that shows a little bit of a disconnect there, and that they have their own story outside of the interest rate story. How are the home builders set up at this point?
Yeah, they do have their own story in terms of valuation. I mean, as much as I say the U.S. economy has not been in recession, certainly not a broad-based recession, there have been segments of the economy that have been in a rolling recession. And certainly housing is one of them, that we saw residential investment contract in 2022-23, and we are seeing it contract again. So even though the overall economy is not in a recession, you could certainly say that housing very much has been. Now, the reason why we call it interest rate sensitive is because of the math then, that with the Fed now being on hold for the last 9 months, resuming their cutting cycle again, what can we expect from housing stocks? And you can see, and I wrote this in my note, that on average, home sales do rise when the Fed cuts interest rates. That didn't really happen over the course of the last year because usually the translation mechanism is when the Fed cuts interest rates, 70% of the time, long end yields or the 10-year fall and take mortgage rates with them. So the Fed cuts interest rates, most of the time housing becomes more affordable and that spurs demand. That transmission mechanism didn't work a year ago.
Right.
But I do think we're in a much, much better position for that to work now. Even again, with the inflation we were talking about, you definitely see a line in the sand When inflation is above 3.5% on a core basis, you don't always see that translation mechanism work. But when you are under 3.5%, and that's exactly where we are from a median perspective on a core CPI or core PCE deflator, which is even lower, you do see that translation mechanism take hold. So I do think that this time, if the Fed does cut, this translation mechanism will likely make housing marginally more affordable. Now, the interesting part this cycle is really the valuation level of home builders. And that is very much what is different this time. Because like I said, what is different is despite the fact that the overall economy is not in recession, housing very much is, and we are seeing a contraction. So what we're seeing now is what we've seen, this rotation into growth stocks, which I still like, technology is still a positive risk reward, has left a lot of these interest rate sensitive sectors for dead from a relative valuation perspective. And that in and of itself usually carries 60% odds, just valuation of home builders working. You add in a Fed rate cut, and all of a sudden, with that translation mechanism, you're approaching 90% odds, which is a really strong risk reward scenario when you think about market.
I mean, we go to the mortgage story. There's actually a lot in the headlines. In Canada, there's a home building discussion going on, sort of a national story here. In the US, there's a big mortgage story, which has to do with the spin-off, we think, of Fannie Mae and Freddie Mac, which are backers and they're kind of state entities on some level, aren't they? What will that release into the market in terms of momentum for your average person seeking a mortgage? Is there a particular connection there, or is that more outside baseball?
There could be. I mean, I think that this is the debate. To the extent that there are buyers of mortgages, and to the extent that these buyers of mortgages are backed by the federal government, and that's sort of the sticking point in the debate, you could certainly see a situation where, among all the other differences this time, one of the main differences is that mortgage spreads, the delta between mortgage rate and the 10-year treasury or the 30-year treasury, has been at all-time wides because of QT from the Federal Reserve, meaning that they've been selling mortgages. So to the extent that this buyer or a natural buyer of mortgages could actually create a situation where mortgage spreads fall more than they have certainly in the last year and a half, you could even see a situation where, as much as the last time, there was almost zero translation mechanism from the Fed cutting to mortgage rates.
It even went
this
up,
time,
actually.
Right. This time it could be supercharged the other way, meaning it might take a more minimal Fed cut to see a situation where mortgage spreads decline much more than you would think. So that actually might create a positive risk reward. And again, there's also rumblings out there, not just with Fannie and Freddie and that spin, but maybe if QT itself stalls or stops in January, that could also create a backdrop for more normalized mortgage spreads, which might mean that mortgage spreads fall more than you would think in any given Fed cutting cycle.
So QT, the Fed just stops buying up mortgages, essentially.
Selling.
I mean, sorry, selling, stop selling.
2020. Yeah.
Stop selling them. So that's fascinating. So the picture of the home builders themselves going through whatever sort of trough you'll take us there that they're in. What is sort of the backdrop of the home builders? Because they've had these enormous cycles. They're cyclical through coming out of the great financial crisis as well as the pandemic. They've had these massive moves. Are we at sort of the cusp of another massive move, or?
Well, it's interesting. So the fun part of my job is to look at the data when you go back in history and really evaluate which sectors and industries and sub-industries have become more profitable over time. And home builders would be a case in point, where you see that generally speaking, in the, let's call it 80s, 90s, and maybe even the early aughts, it was really not I don't want to say it wasn't a for-profit business, but they certainly didn't maximize profitability. And I think that all changed in the late aughts and certainly after the financial crisis. And if you chart operating margins or returns, we are seeing some of the most the highest levels in the data that I have going back to the 60s. Now they're down off all-time highs of 2020, where you would certainly say that the builder stocks and anybody exposed to housing was over-earning, and you've seen a substantial decline in operating margins since then. But even just from a steady run rate perspective, these are much, much more profitable companies than they ever have been when you compare them historically speaking. And that's the interesting part to me, because for the most part, the valuation levels have not changed. The absolute valuation levels are roughly the same as where they have been in the past. No real different, despite the fact that these are much more profitable companies than they ever have been. And on a relative basis, and this gets back to the interest rate sensitive sectors left for dead, on a relative basis, they've massively derated relative to the rest of the market as we've seen this shift towards technology, which is in its own more profitable. Now, the interesting part to me is that as much as I still think that technology is a risk reward, a positive risk reward, I do think that we need to be open-minded that there are many other sectors and many other areas that we should be looking at as investors. And given this is sort of teed up by it being different this time, you might have a better translation from the Fed cutting to overall interest rate sensitive sectors, plus the fact that a lot of this is already priced in with the relative valuation being where it is. I think that creates a unique setup where the interest rate sensitive sectors might even be able to keep up with those more cyclical, technology oriented subsectors like semiconductors.
That is fascinating. So you mentioned operating margins are at their lowest. They've been able to make sure that those are a place that's manageable for them. There's a big discussion about margins, certainly across many different sectors and industries, but it seems like particularly in the home building side of things, I mean, it's only anecdotal, but it seems like everything's incredibly expensive for costs towards anything to do with home improvement, building, and so on. Is that not the case for these companies?
No, it's definitely the case. So there actually is in a segment of the PPI, there is the construction PPI for builders specifically that you can look at. And I wouldn't say that it's gone up a lot since the pandemic, but it hasn't gone down at all. Okay. Meaning that the builders saw this massive cost shock and it hasn't gotten any better since. I would say that on the margin, it hasn't gotten any worse either, at least the way I look at the data. And we've already seen a pretty significant margin decline. So again, always remember that as much as, yes, costs are high, and in some ways, housing is uniquely unaffordable, right? It is very different this time. The question as it comes historically is, do these stocks price in bad news ahead of time? Meaning is there a situation where, yes, costs are high and continue to go up, and yes, housing prices have to come down, and are you at the valuation where the stocks can work anyway? And when I look at the math of that, that's exactly the situation I see. So the odds that when margins decline, do home builders decline with them? Actually, most of the time, they don't. In fact, a lot of their outperformance comes when margins are declining, which doesn't tell you that margin declining are good, but it does tell you that the stocks have a really strong track record of pricing in that bad news in advance. And the interesting part for me, at least in sort of the rock, paper, scissors world of probabilities, when you look at house prices, given our starting point on mortgage affordability, meaning that housing prices still need to decline, which is fairly rare historically, right? On a national average, 2009 was really the exception, not the rule, where housing prices declined. So maybe that is the situation currently. Well, interestingly enough, when you look at the starting point, as your point, starting points matter, when you're in this level of valuation, meaning the bottom quartile, yes, you underperform on average if you're a home builder stock in terms of relative to the S&P 500, but not by a lot, about 300 basis points. So your downside is fairly limited because, again, historically speaking, stocks have usually priced in the bad news ahead of time. And if you are wrong and home sales do bounce and that translation mechanism does work, you have about 30% upside. So from a risk reward perspective, we usually like to use 3 to 1. I'd like 3 to 1 my upside to downside. This is more of a 10 to 1.
Wow.
So I think, again, there are no guarantees, certainly in the stock market or really in life. But when you see a risk reward like that, I do think that there's a fair amount of alpha to play for.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connect's The Upside and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
That is fascinating. And add on, there are a lot of offsets and other things that come into the story. Interest rates is a massive, blunt instrument that we know about for this particular sector. But what about on the policy, on the fiscal policy side of things? So the one big beautiful bill, we've got the tax cuts. You have to imagine for home builders, all the lines of depreciation that they can add in earlier on and so on will have an effect as well. How does the sort of the policy, fiscal policy side of things fit into this?
No, that's exactly right. I mean, for corporate America, if you sort of do the math of a potential headwind from tariffs, which are the cost shock, and then sort of do the math of the potential tailwind from the legislation that was just enacted, it's 2-to-1 positive legislation versus the tariffs that we've seen. And I don't think builders are any exception. In terms of capital intensive businesses, this is a boom. So you will see more profitability. I mean, it's an odd time to think about it because we're seeing in the overall economy, there's very, very little job growth and potentially now a negative revision that might actually lead to a contraction in job growth that we'll see now in retrospect. But with that, you are seeing not only right now with profits growing 10%, but you're actually seeing quite a strong tailwind for profits over the next 12 months. And to your point, home builders are really no exception. So you do have a tailwind on top of this starting point in terms of relative valuation. So it does increase your odds that you get that dual tailwind of you get better earnings growth and valuation expansion, which is something that we're always looking for as investors.
Fantastic. Okay, a couple of questions going to different sectors. We might circle back to this one as well, but asking for your outlook, I think this is at the bottom, for oil, gas, the energy side of things. Looking a little further out, so a year and beyond, it's been a rough go. There's lots of oil. How do you take a look at the energy sector, that particular part of it?
I think it's still going to be rough. And I think that the main reason why it's so rough is the renormalization in profits. And look, that can go two ways. I mean, it can go quickly in time, meaning that profit margins can fall a lot, and maybe you'll get a different answer from me in 6 to 9 months. Or we can sort of drift lower, like we have been drifting lower, and it takes 2 to 3 years to get to more normalized profit levels. To me, this is the biggest statistical headwind for the energy sector, which is to say that 2022 was the most profitable this sector has ever been. And that's a problem from a starting point perspective. So when you have an oversupply situation, yes, we can debate how oversupplied it is, but when you have that situation on top of the fact that you are already starting from a very profitable level, you are much more likely to continue to normalize. So that means the energy sector is seeing margin compression at the same time where other sectors in the United States are not seeing that. So from a relative perspective, it looks much worse. Now, I think that there are a lot of investors that say, well, the fact that the stocks are cheap should offer some downside protection. And this is where I think history can help. I can show you the statistics that that's usually true in home builders. I can show you the statistics that that's usually true in technology. And I can show you the statistics in energy where that has not been the case historically. Energy is the only sector where you get trough multiples on trough margins, meaning you get bad business conditions and you get cheap stocks on top of it. That makes them very tricky to play to be early from the cycle, but it also makes them go up a lot when you have that bottom of the cycle, because they're one of the only sectors where you get that dual tailwind coming out of a downturn. So there will be a time when energy can not only keep up, but will easily beat the market. But I don't think that we're there yet. And it could take as long as 2 to 3 years to get to those normalized levels.
That's fascinating. So let's actually, just for your sector lineup, top and bottom, I think you said tech for your top three in the past. Let's get those. And I want to ask you about Fed independence because we really need to get your thoughts as we get closer to this meeting. But yeah, top three, bottom three in the sectors.
Yeah, I will say my top three have basically been the same, right? Tech, financials, and consumer discretionary, and I keep changing the rank order, right? So the last time I really wanted you to focus on technology, and then it was financials and then consumer discretionary. I'm going to re-rank them again. Tech is still the first. I do think it's the best risk reward. They have the best fundamentals in the market. Now I would say consumer discretionary, given their rate sensitive nature and the fact that I think that the translation mechanism is much more impactful this time around, and specifically because I think home builders are a better risk reward this time than last time, consumer discretionary is now ranked number 2. Financials would still be number 3. I do think that as much as I'm enamored with banks because they have a good starting point on valuation themselves, I do think brokers and capital markets look much more interesting from a leverage to the market perspective, which I think that we're in a secular bull market. So on the downside, let's pick on energy again. I would say that energy is not a sector that I would recommend owning. And I would pick on, in conjunction with energy, the utilities sector. So yes, it's in the bottom half of the distribution in terms of the valuation. No, I don't think it's a really succinct AI play just from a sector level. You can certainly say it's one of the better defensive sectors, or at least it has been, but I think that creates its own negative risk reward. Usually you want to sell utilities after they've worked, and while fundamentals isn't necessarily negative, I do think that when you see sort of the Fed cutting in a non-recessionary perspective, utilities has one of the lowest odds of all the sectors. So in terms of not to own, energy, utilities, and then I'll add in consumer staples as your other classically defensive sector that I think has a negative risk reward.
Fascinating. So interesting. Such a different skew to what some people look at with the rate decision. It looks like on the horizon. This rate decision has been discussed 1,000 different ways because there's a politicization of the Fed makeup. And I'm really curious on what your thoughts are on the independence question. First of all, does it matter if they're completely independent? Maybe they never have been completely independent. Take us to where you see a sort of meeting point here.
Yeah, I always think that there's a difference between, what we debate sort of in the kitchen table format versus what we think is most important for investing in stocks. And this is where, I think that there's a wide range of outcomes as it relates to this. But I think to your point, I'm not totally sure that the Fed hasn't sort of had an agenda that was completely independent over the last 5 years. I think that 2020 was certainly, we saw an aligned administration. So I think that there's a lot of arguments. Are you sure, number one, that this is really a critical difference from anything that we've seen over the last 6 years? So number one, you have to make that is an argument that, again, I'm not really sure. I think number two is that you also have to argue that now we think that policy from that perspective is that the administration will get exactly what they want to get. We've talked in the past of, look, administrations, they can do a lot of things, but a lot of the times the ultimate arbiter is the market. And we don't have to go back very far to see that. So just because they want a different result doesn't mean they get a different result. And then the third point, I think finally, is are you certain as an investor where lower interest rates aren't the correct policy? Because if they are the correct policy, then again, it might not be a situation where the market has an issue with it. And I've long since said, when you take housing of it, even on a CPI basis, the overall CPI was at a run rate of around exactly 2% for the last 18 months. It's ticked up a little to 2.5% outside housing with tariffs, but generally speaking, inflation isn't a broad-based problem, which means that 4.3% from a Federal Reserve perspective, when there's very little growth in the US economy, doesn't need to be that restrictive. So I think that you can make a credible argument that interest rates could be lower. I think that you can make a credible argument that there's not really that difference in the Fed over the last 6 years. And I think you can make a credible argument that even if the administration wants a certain result, they might not get it. All three of those arguments mean that none of this might have the impact on the market that you think it might have.
It's so interesting. The phrase data dependent and data dependence, where does that belong now? I mean, it seems like data has changed and there are reasons for that. And some of them might be meddling and some of them might be other things. We don't really know. But depending on the data and the pieces of data that come out to guide what the market is trading on and thinking that will guide investment decisions, is that the same as it was 6 months ago?
Well, that's the irony. I think that the data dependence, I mean, I think that we can all look at the BLS revisions and we can all say, well, those are big revisions and what does the response rates mean? And should we change that and make the data more, a little bit more robust? But I think that at the end of the day, you have to step back, look at all those revisions. And I think that we knew this from the beginning. The data dependent nature and the consensus building of the Federal Reserve has a major flaw in it. To the extent that you are making decisions with data that is heavily revised and not particularly clean, does set you up to be potentially behind the curve. Yeah. And I do think that that is something that the market understood that. And I think from my perspective, as you say, okay, well, doesn't that have an impact that the Fed is now chronically behind the curve because the data that they get is heavily revised and it's really in the rearview mirror? From my perspective, when I look at that data, it looks to me more like that the Fed follows the cycle rather than creates the cycle most of the time. And I say that because as much as people had said, oh, we're going to see the long lags of monetary policy when policy was overly restrictive and then that's going to cool the economy. Look, you chart the data and you look at the quartiles and you say the higher real rates are, what do I see over the next 12 months? The more likely GDP is to accelerate. To me, that tells me the Fed more often than not, A, doesn't make a policy mistake, but B, follows the cycle rather than creates the cycle. So as much as we can sort of pick on the fact that, hey, the data dependent nature of the Fed, now looking at the data doesn't make a whole lot of sense, I'm not totally sure that it is any different as it relates to the economy and the stock market than most of the history that we already have.
So what does it do then to the discussion of leading indicators? I mean, the non-farm payrolls is not a leading indicator, and so there's the other job pictures that you use to help with that. But, I mean, can the Fed use leading indicators? It certainly tries, but, I mean, are they able to do that if you think, in fact, they're following the cycle rather than creating it?
I mean, that's the tricky point that I would say, Powell addressed early on, which is to say that our forecasts weren't right for transitory inflation, right? So we will stop making as many forecasts, right? So they think that their economic models, and look, everybody's got to have a model. Sure. All models are wrong, some models are useful, right? That quote that we remember from 2020. I think that is the debate. Can you use leading indicators? Well, they can't in terms of the economy. I think it's been a tough slog. And obviously the GDP changes, the trajectory has changed a lot. For me and my work, the maddening part as equity investors is that equities are the ultimate leading indicator. Right. And that's the nonsensical part. So I just had a conversation with a portfolio manager that said, yeah, but Denise, now we might think that actually jobs are in contraction, right? And that maybe even, in fact, the NBER will say in retrospect that we had a mini recession. That's definitely possible if we saw a peak in jobs and jobs persistently decline over the next 6 months, which I think you got to be open-minded and say that that's certainly possible. Isn't that a problem now that we've snapped all the way back to not only the highs, but well in advance of that? And I said, yeah, but when I look at the data, that's what stocks were already telling you in April. When stocks go down 20%, you usually see that negative result follow. So what does it mean that stocks have advanced so rapidly? I think it means you need to be open-minded that was a potentially temporary soft patch, and the stock market is potentially correctly predicting the fact that growth and profits will rebound. And I think that's the situation we're in. So if you ask me of a leading indicator, I sort of look at that, and it's interesting because you say, well, no, we should think about it the other way. If stocks are heavily valued, then that could create a downside view. And what you see is stocks going up a lot usually means that the economy gets better. So now all of a sudden you start having to bet on the fact that stocks are wrong this time when most of the time they are not wrong, in fact.
That's what it has. Yeah, it would have to equal that stocks are wrong.
Right.
To make that work. That is fascinating. Your perspective, I think, changes all of our views just a little bit each time. Denise Chisholm, thank you very much for joining us. Have a great rest of your day.
Always great to be here.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.